Over the next few weeks, the SAMRRA Old Mutual Alternative Investments Multifamily Series will take you through a number of key topics showing how multifamily is a defensive, investable asset class. I will be joined by the institutional landlord CEOs alongside key fund and asset managers and pension fund executives. The series will be educational to trustees and decision makers and will clarify some standing misconceptions about the industry. Welcome to another episode of the SAMRRA and Old Mutual Alternatives Multifamily Series. Today we have Vanessa Perfect from Houss and Heleen Goussard from RisCura. I'll let them introduce themselves before we get kicking.
Good morning, Palesa. Morning, everyone. Morning, Heleen. So Vanessa Perfect. I've been in the property industry for now almost 2 decades, even before prepaid meters was a thing. So really got my grass level understanding of property through City Prop. We're actually working on the grassroots level with property, and then made my way through the ranks, became an asset manager for IHS, and then eventually we listed a fund on the JSE, a pure residential fund, and right now I'm looking after a portfolio of 8,500 residential units, a little bit of commercial in there, but mostly residential at a value of just over 9 billion rand. So we run the company with 200 people, and that's a full-time job.
Massive. Heleen, can you tell us a little bit about what you do at RisCura?
Sure. Heleen Goussard. I work at RisCura. I'm the head of alternative investments. What we do at RisCura is we are asset advisors to institutional investors. A business like that has a bit of different arms. We have large institutional clients for whom we give advice, and for which we would support them in selecting investments, but the final decision would sit with them. And then we also have an arm where we do discretionary investments, where clients give us a mandate and we would then do investments on a discretionary basis for a pool of clients. And I head up the unlisted investments or alternative investments portion, and then have spent time on both of those products. What I also have a very large involvement with our ESG, responsible investing, impact investing, a function, and a portion of that also involves that I am the portfolio manager for our impact fund, which invests in multiple impact thematics, including affordable housing.
Great, thank you. Vanessa, so you're running 8,500 units across a 9 billion rand portfolio. Where does the value actually come from? Is it the rental income? Is it operational leverage? Is it capital appreciation? Or is it something else that analysts and people like Heleen might miss?
I think there's a misconception in the market that the value lies in the actual property that you buy. And what really makes the numbers work is the sort of engine that sits behind that. I mean, you could have a building or 2 buildings right next to each other, same spec, same street, and they will operate or they will function completely differently in terms of the returns. So I think sometimes where investors, especially institutional investors that doesn't know the market very well, I think, they miss the sort of hidden value adds that come from that operational excellence, let's call it. I can give you an example, for instance, in your speed of your vacancies. This is very different to the commercial space. We have 300 people leaving us every single month. We have between 400 and 500 new people coming in. And with that, we've got what we call back-to-backs. So in other words, the person that's leaving on the 31st needs to leave by 12 o'clock for the new person to move in on the 1st after 12 o'clock. So there's a machine that sits behind that in being able to churn those numbers. But it actually starts before that because, we've got a system that actually tracks the occupancy status of a property. So when a tenant gives notice, immediately it changes the stock item to vacating, which helps an agent agent to be able to what they call book the unit. But the unit can also only be booked for like 48 hours before there's some kind of action in terms of payment, etc. So it's a long story, but the point is that the stock gets treated on a granular level in order to maximize those vacancies. It's not just about putting somebody in, but it's about the speed of getting people into the property. And I could talk about this all day, but there's other efficiencies in terms of the collections and the way that you treat your tenants in terms of the response times, the people that sit behind it, your company culture, your leadership. There's so much that goes into it, but for me, that's the secret of the success, is really how those properties are managed.
Yeah. So what you're saying, Vanessa, is that essentially this is about the jockey you're backing.
Exactly.
Well beyond the property itself.
Exactly.
Heleen, when you started hearing about things like affordable housing, multifamily, where were the pension fund trustees? Where was their sense? What was their feeling? Was it a case of, yes, finally, here comes a sector that we really want to back, from an impact perspective or whatever it was? Or were they saying, really? Is this something investable,
I mean, I think the first thing to understand is that institutional investors aren't a homogenous block of money. Different pension funds, different medical aids, different, development banks, different, whoever you are trying to maximize a balance sheet for or help design an investment strategy for, has a different view. What is interesting about it is, each one of those let's talk about pension funds for a moment. Each one of those pension funds are developing a view on what they think impact is, right? And as I say, we do have a pooling mechanism whereby we allowed our clients to put some of their impact-aimed money together, and then looking at what they thought was important. And I think that's the important part, is it is about what the client wants in the end and how they view impact. And we know that is how impact works. People need to define it for themselves. And I think what was interesting, I think almost any client you speak to will talk about housing as being something that is important. I think where the issue is, or, one of the difficulties that we need to overcome is how they see that playing out. For some people that does mean multifamily living or affordable housing. There's also the social housing portion of it, which they may want to support. There is pension funds which have a lot of members which are currently working very far from where they live, and supplying some options closer to where they live might work better. So there is very different thinking around how to look at housing. But what I would say is almost all larger institutional investors are starting to think or have thought about how they want to view impact and how they want to go about it. What I would also say is let's say that housing is a thematic that is included in their thinking around impact. From an implementation point of view, what we have found is, being able to put a diversified offering together in terms of what that means for them to invest in, is more difficult than a lot of other impact thematics at the moment. Yeah.
I must say, over the years where we've tried to, because Transcend was a very new residential REIT, and so we went with the hard yards of trying to, get the market educated about residential and growing this fund in a listed space, which is under huge market scrutiny, in a market then that was relatively unknown. So we did road shows. We saw so many people on bulk, individual. And you're right, we met so many different kinds of investors with different requirements. And impact was obviously one of them. But besides the impact, I mean, like you said, everybody needs a place to stay, right? And if that place is clean, it's safe, you can just go to one of our properties and you can see the domestic worker playing with the kids, where the parents are safe to be able to work and leave their children being able to play in a security estate. That is impact, right? And So the point that I'm trying to make is that when you speaking to these investors and they have their different requirements, it does essentially still boil down to returns. So besides having that impact conversation, which we gladly have, and it's quite evident when you're in the property, when we really start talking about the numbers and the risks and associated risks, and even though there's a thread in terms of every investor wanting to understand what their money is going to do for them, at the end of the day, there's also the bigger picture and the longer term view in terms of even where South Africa is now with residential and where we want South Africa to be one day.
I mean, I think that is quite an important point, is that institutional investors do each have a return mandate. You know, yes, they think about impact, they bring it in, it's a thematic, it is a overlay. But for most of them, their primary objective and outcome is returns-based. And I think that has also been something which has been harder for consultants, institutional investors to wrap their minds around, is the return profile versus other property investments versus other investments. The other thing which we've also found over time is if we are competing directly head-to-head with the banks in terms of supplying capital, we must probably not in the right space. Sure. And so, you know, we would more likely to be supplying mezzanine funding. On the equity funding side, we, you know, definitely for the remainder of property and residential, there hasn't really been a thing. But, you know, equity property on commercial and industrial has been a long-standing part of the portfolio. But I think that's been part of the issue as well, is to find the entry point where we think, you know, multi-living gives us the right risk-return profile. And we are playing in the right space in terms of supplying funding for it.
I've seen, and perhaps I don't understand the sector well enough, but when people take a view, investors take a view in the other asset classes, for example, like commercial and even students, you know, and when you compare the risk profile for residential versus the sort of alternative real estate asset classes, I almost can't understand why they think residential is higher risk, and that's why we haven't taken a view yet. You know, in the commercial space, we own a shopping center, and I had sleepless nights. What happens when Checkers or Dis-Chem moves out? What are we going to do with the shopping center? You know, what's going to happen with the other tenants? And even students, you know, we've got a student building as well, 1,055 beds. We literally vacate that entire building. We reoccupy it every single year. We literally like holding our breath, hoping that we're going to have this building full in the 3-month window that we have. Sure. I mean, those for me are real risks compared to residential. I mean, the sheer diversity of what we do takes out the risk. If you have 300 tenants leaving, you've not got 3,000 tenants leaving. When you've got collections, exactly. And, you know, the collection question is always one that comes up in the residential space. And I'm going, you know, we sit with like a 1.47, 1.5% bad debt. And I say, but you got delinquent tenants. How do you get these delinquent tenants out? I'm going, you know, on a scale of 8,500, we at any point have 20 what we call legal files, where the attorneys take over and it follows a process. And yes, that process takes 4 to 6 months. It might cost you 20 or 30,000 rand in legal costs, but in the bigger scheme of things, it's a drop in the ocean in terms of what we're facing. So in terms of the typical kind of things that investors are worried about in terms of risk for residential, I just don't see it. And I'd be curious to hear your idea of what you think the risks are.
I mean, I think maybe to some of those things which I think are interesting, you know, we've got quite a bit of student housing in the portfolio already, which is interesting. But, you know, for instance, some of that is de-risk in the fact that parents pay upfront before their child even gets into.
That must be Cape Town.
Yeah. Fair enough.
Not Joburg.
You know, which is a very different risk profile. And I agree with you. There's this massive demand and undersupply, which at the moment makes it an easy decision, right? If a parent is paying upfront actually in October already for their child to occupy in January, and I have my income all the way to the next December, you know, that's a very, very different risk profile. And I do agree. Something I can understand is that, your point around being a good jockey. But in some ways, that's the point, is that you do need a very good operator and jockey. And by that's nature, that means I'm taking more risk, because I'm taking a risk on the asset class, I'm taking the risk on it, but I'm also taking a risk on the jockey. And I'm not saying that commercial guys don't need to be good jockeys, but I mean, the level of operational responsibility you guys have and how important the correct execution of that is definitely more elevated than, correctly, as you say, than other areas. What that means is a really good jockey is worth a lot, because I can, the risk premium on that makes sense, and you end up making good returns because you have a good jockey. But, those things do still add risk to the outcome.
So you've got some student exposure. How much residential exposure have you got?
Outside of student exposure, we don't have a lot of residential exposure. What we have had some exposure to in terms of people offering us opportunities, and what we're looking at is supplying the mezzanine portion of development finance. Of the developing portion of the process. And a lot of that is for multi-living, and is, which has given us an opportunity to get a point of access, which we think is relatively impactful, while still managing the fact that, the debt is for a limited period of time. It gets repaid. We can recycle that money. We have good line of sight in terms of where we're going with that, which also helps us with the liquidity issue, because, like most developing asset classes, the question is, once we're in, how do we get out if we need to?
And is there certainty of getting out?
Is there certainty of getting out, and where am I going to find somebody to buy that? Even if it's a good asset and I need to rebalance a portfolio, can I rebalance this out? So part of that is also the debt portion is quite attractive to us because it is self-liquidating. We can see an endpoint to it.
Has that been the biggest hurdle for you guys, why you wouldn't have taken a view before now? Is that exit strategy, or is there other things that...
I mean, exit is definitely a portion of it. I mean, if we think about what is important to us in our portfolios, is I know that I have the right risk-adjusted return for the risk I'm taking. I think in this asset class, because it is so developing, it's not just... It's not easy to know what the answer is in terms of what is the right risk profile, right? And so that can be quite difficult. Is the question, should I be getting 10%, 15%? I don't have a long history of seeing what other returns have been, what default situations have happened. Let's talk about debt throwing, how much default we've had, so I can't really judge from the numbers where I should be, which is difficult. So that's the first thing. I don't have a lot of a history, and I don't have a lot of information. I think, yes, the second thing is liquidity does matter. And to be fair, a lot of our clients can take liquidity risk on. That is one of the positive things about pension funds, especially in South Africa. We've got a young, growing working population. And so most pension funds are cash flow positive. In other words, there's more cash coming in than they need to pay out for pensioners. There's the exceptions in the industry, but, overwhelmingly, because we've got a young country, cash is coming in. So in some ways you can take that risk, but it's not, sometimes people say that relatively blasely about pension funds, but it's not quite as simple as that. There's a couple of things. There's firstly, as you say, a good jockey is important. And sometimes circumstances change at the jockey. Now I've got an asset which I may not have backed if I had to reconsider it today. And so that's one part of it. The ability to exit when the quality of the asset changes, is also important. It's not just a matter of whether I can hold this in terms of liquidity. And then we do have regulatory bans, and so at some point you may need to rebalance. And again, then if the asset's entirely illiquid, that can be problematic, which is one of the reasons why we've actually used debt as an entry point for a lot of these things. So I said that self-liquidating, somebody else would most probably refinance it, and we can make what we think is a good return for that. But there is, quite importantly, it's not our space to play where the banks play. And so, it is sort of important for us to understand where in the capital stack we would play, and what the risk is that is connected to that.
Vanessa, just a question to you around returns and stability around returns. We spoke earlier about where the source of, stability comes from, and we said the jockey, and one question that tends to come about quite a bit when we speak returns, especially in residential, is whether it tracks inflation and whether, can we anchor it to something that sounds pretty mainstay to others, which is this inflation story. And a lot of the work we're trying to do at SAMRRA is around the data piece. Heleen speaks about the difficulty of investing when she doesn't know what has happened historically. We know some of our members have been in business for those 2 decades. And there's some funds like Old Mutual's Alternatives, HIFSAs, who've also been around for that long. And the issue is not the lack of data, it's just the lack of consolidating that data and putting it together. And we're doing a lot of work at SAMRRA towards putting that out so that you can start to see exactly how it performs. And we can use a line in the sand and say, look, over this period, look at what vacancies are doing. Look at what cap rates are doing. And my question to you then, Vanessa, is around, do we track inflation and how do we behave over a COVID period? How does residential react to shocks that we've seen in our economy and others?
So we recently did a substantial transaction of just short of 1.8 billion rand. And I think that's a significant milestone for multifamily in South Africa to be able to do a transaction like that. But the irony is that building didn't just pop up overnight and it's now significant. It's been around for 5 years. So, and the likes of an SA corporate, they're obviously very sensitive to the yields that they're buying at because they're under pressure from distributions and obviously the market sentiment. But to answer your question, they would not have taken a view on a property that doesn't show consistent growth and cash flow and good operational metrics. And we're not their jockey anymore. We were the jockey, and fortunately SA Corporate has their own jockey in terms of AFCO. So they understand those dynamics as well. And that was a transaction made in heaven. So in terms of tracking, I think at the time when the country was at its absolute worst in COVID, the sector has really proven itself. It's not just saying we're resilient and it's a defensive asset class. It has actually literally proven itself compared to the commercials and all those kind of things. At the worst, we were 91% occupied and we had less than 3.5% bad debt. And why? People need a place to live. And I think the difference is what you said is hopefully now that more listed entities are understanding this market and actually realizing the value that is created through the multifamily sector, that information is now more visible to other investors. And, because of the regulation involved with the REITs, maybe they feel more confident in the information that's being disclosed through these REITs. So I think that's definitely a sign of the market maturing. So does it track inflation? For sure it does. Maybe not in a linear approach, but certainly, I remember old Mr. Wapnick, where Alec Wapnick from City Prop, he always says to me, Vanessa, if you're 100% full, your building is too cheap. And if you like 97%, you're too expensive. So that's the advantage of residential, right? We can correct pricing at a drop of a hat. If one specific unit type, third floor, 3-bedroom, first floor is not selling well, today we make the decision, tomorrow we change the price, 100, 200 Rand price adjustment, and then we're full again. And there's very few sectors in the real estate industry that is that flexible. So it definitely tracks inflation, and more than just rent escalations, right? There's so many things that go into income growth as opposed to just the rental escalation.
That's true. You've got a lot that you offer beyond just rental when you're operating these units. Heleen, if you were to do due diligence on a portfolio of multifamily, how different would that be for you to doing it on a regular PE fund or something else that you would be looking to put money into?
Yeah, I think the big difference you mentioned there is quite important. Is normally I would be doing due diligence on a PE fund, not on a PE portfolio. And that is the level at which we would normally be sitting at, is we would be offered options from asset managers who are collating investment opportunities within the sector. We would be in a position to be able to make sure, and that's another level of jockey, that jockey is the right jockey. At the moment, there's not a significant supply of those coming through the market. I think we can all agree that. What I do think, what we found for other impact themes in which, is slowly starting to happen here as well, is, that there is generalized debt funds, just good old fashioned unlisted debt funds, or debt with listed and unlisted mixed with some credit in there. And a lot of the guys had renewable exposure and then started having, exposure to toll roads and to other schools and to whatever it is, because not necessarily because it fitted the impact bracket, although some of those funds do have like a generalized impact thematic, but just because it was good credit. And so my expectation would actually be that I start seeing it come through in portfolios from that point of view, because that's been for every other impact thematic has been the case, is you've put your case to a credit manager who has 20 other credit options available. They've looked at it. They're happy that the pricing and the risk is correct. It starts coming through in the portfolio. It starts becoming more normalized as an asset thematic. And then, for the asset owners who want to focus on it and want that specifically, you could start carving it out into a portfolio.
So you're saying what I'm hearing from you is that we need aggregators.
We need aggregators.
We need aggregators to see the scale that we're looking for in multifamily. And in order to see more investment, we need to see more of a coming together of these assets in order for the decision to be easier for you also.
Yeah, and as I say, I think the correct entry point for it is there are multiple large credit funds which have started off, funding a lot of the stuff that have gone into thematic aggregators in the end. And what is quite nice about it is it does give you a good understanding of where you sit in terms of risk and return profile. If nobody's interested, you understand that there's something odd going on. And if you start getting pricing back, that also gives you a good understanding
of where
you are actually placed within
the market correction element.
And it might be risk perception versus risk reality, because there hasn't been that much investment in there. And I think, this kind of work that you guys do is really important in terms of making sure that the perception of risk actually matches the reality of risk. But, most of those players are looking for opportunity. I always say in South Africa, we're really good at creating capital because, the pension system creates capital, the insurance companies create capital. The question's never whether you can find capital, it's whether you can find the right investment opportunity. And so, those guys will start competing with each other if it's a good quality investment opportunity. And so,
we need to see more of that, to see more of interest coming from the other end.
Yes, yeah. Because once you get it into generalized, it is at least in the ecosystem. Then aggregating suddenly becomes a much more sensible outcome.
And while debt is the big play on your end, do you see an opportunity, just based on your experience in the industry, for significant equity to start playing in this space?
So I do think so, because I think, from from the remainder of the property industry point of view, it's always been, both of those things are attractive. And I think the inflation tracking, reality of it is you don't necessarily get the access from a debt point of view. I mean, there are places in the world where they structure that debt with inflation, but that's not us at this point at all.
No.
And we are very much aware of that inflation tracking quality of property. And it is something which is very attractive to us when we have inflation-driven liabilities, which you do when you have a pension fund. And so from that point, it flares up as attractive. Again, the access issue becomes how and where. And so, as I say, it's definitely on the map in terms of interesting, because it gives you that. And again, investment opportunities is the thing which is limited. So any investment opportunity that, meets criteria risk reward wise and happens to fit my liability.
Somewhere to put the money.
Yes, exactly. and it fits a lot of my requirements, so,
Lovely. Sorry, Vanessa, you wanted to say?
No, it's just a small comment. Obviously I understand from, investment committees or credit committees, and, they have their processes and their spreadsheets, and the documentation is to support the story. And yes, the numbers need to stack. And I sometimes wonder why they feel the numbers don't stack from a residential perspective. Yeah. But I wish I could just take them for like half an hour, and just sit quietly in one of our estates, especially during the school holidays. You cannot take away from the fact that the impact that you can make to people by merely seeing the group of young men playing soccer, and it's so serious, and and then you see the dad who's just come home from work and he's pushing his child in the swing. You cannot replace that kind of stuff, and you cannot convey that kind of impact in a spreadsheet, so I just wish more people understood what we do.
Yeah. I think that speaks to institutionalization as well, which is something that SAMRRA works towards, to say, when we came up with the definition of multifamily, this institutionalized part was important. It goes down to the jockey. It goes down to the fact that this is a building that will forever be rented residential. You're not going to wake up tomorrow and find out, hey, I'm selling, cheers, please go find yourself somewhere to live. It comes down to the amenities, which Vanessa's spoken about. And when you're not in the large residential estates, even in those 3-4 story walk-ups, you've got a swimming pool, places to work in the day. You've got cinemas and some of our members, things that'll come out in this series, and that we've also heard of from our other members. So there's definitely a need to make sure that we spread the word regarding the difference between you and I renting out an apartment and having established institutions that are very much aligned to all rental laws, very much aligned towards responding to shareholders, investors, funds and fund managers. So very well-behaved institutions, so to speak, and what it is that they're driving, yeah. and the fact that this isn't something that's disappearing. Yeah. When I started in this industry 17 years ago, I remember having to help the investees that we were going into around formalizing certain elements of what they're doing. You look at those very individuals today, those very entities today, mature project management, property management, and mature asset management, which are two different things. And Vanessa always tells us the difference between property management and asset management when you're running these buildings. So I think there's something to be said about how much scale needs to happen from a pension fund point of view, and how much maturity is happening from an operator point of view. And I think our discussion today has really cemented that, there's interest from an investor point of view, and there's expertise and running of amazing buildings from the likes of Houss. Before closing us out today, I just thought I'd get final comments from both of you. And I know I've wrapped up how amazing you are at what you do, but I think, if you could give us some parting shots on what people definitely need to look out for, perhaps, before you'd be super interested or put more money into it. And maybe from your side, Vanessa, what needs to be remembered about, where returns are at in your portfolio?
I think the last thing I agree with you around the impact story, and I think that is really important. And as I say, we find that our clients are more and more defining for themselves what they think impact is going to be. What I would say is what that has forced us, and in turn, which we have needed to ask our asset managers to also think about, is how we report impact. Because, a good narrative definitely helps, but the right measurements consistently reported in line with international standards of that is the right metric for the right type of investment, I think is becoming more and more important in the market. And having that easily available makes it much easier to make the impact case, rather than as a generalized thing, but as a very specific thing. And so I do think we need to think about that. But otherwise, I think that this is, considering that institutional investors are so interested in making sure that their money also makes a better place for people to live. I think it is such an obvious spot of interest or area of interest. It's just finding the right way to get the water from point A to point B, which is not always easy in the investment industry.
Yeah. Now, from my perspective, I mean, I always look forward to an opportunity to be able to educate the market and for the people that are interested to hear the story. South Africa is a third world country, and yet, if you compare our residential sector to the international markets like the US and the UK, we are minuscule and we tend to follow those trends. So is there a growth story here? For sure. We've got to grow. We've got urbanization. We've got, the lifestyle patterns of our youngsters that are changing, wanting a rental. There's affordability restrictions. It's got nowhere to go except up in terms of the growth story for residential. And I was recently in the UK, and I saw for myself some of the supposedly institutional rental. We're way above the international markets in terms of the way we asset manage and property manage and the quality of the assets that we deliver. So as much as we are a third world country, I think we're far above everyone else in terms of the way we do it.
And I think we'll end there. Thank you very much, Vanessa, and thank you very much, Heleen.
Thank you for joining us for this episode of the Multifamily Series podcast, proudly brought to you by Old Mutual Alternative Investments.